by Sam. I think it's overall been a decent quarter for the portfolios, as we'll sort of move on to during the presentation. I think the next month or two will certainly be dominated more and more by election after election after election. Obviously, lots of noise, sort of particularly in the last sort of 2-3 weeks in that space, both in the UK and probably more of a volatile nature in France and other countries. But as we've sort of said, this is crunch time now. Lots of elections around the world, which will alter things. It's been a little bit of a sort of sideways movement in markets in general, but I think as Sam will move on to, showing the value in our active management and some of the earlier decisions, that even in a sideways market, we've sort of definitely demonstrated value in both the sets of the portfolios, which is very, very pleasing. Sometimes in a sideways or downward market, it's actually easier to deliver alpha in a upward market when things tend to run away, become a bit herd-like in their movement and processing. Actually sometimes the sideways movements helps us prove the role that we're doing. So I'll hand over to Sam to take you through the prepared slides.
Good morning all. It's great to see some familiar names on the attendees as well as some new ones. As Mark mentioned, from a macro perspective, a bit of a sideways market, but we had some areas in our selection that helped us generate outperformance, and of course we'll go through that in a minute. Looking at the quarter in general, you saw that generally positive earnings results, an acceleration of earnings growth, which is obviously positive. The last year was, although we saw above expected earnings results coming in, there was a general slowing down, whereas this year things are picking back up again. So that's excellent. One thing that has been a constant from the beginning of the year was that government debt yields were increasing off the back of overly optimistic expectations at the end of last year. So that meant that, of course, as yields rise, the capital value of bonds decrease. So that was having a negative effect on the debt markets up till around about the end of April, where things found their limit, and that fed into, say, their duration exposure. So that would be whether we're favouring parts of the debt, sort of the bond market that are more volatile to those changing yields or less so. So we were more exposed to less volatile elements of the market to increasing yields, but we switched that over in the end of April rather successfully, and have benefited off of that as we went through May and June. Hypnosis, which no doubt you'll be glad that we're going to be talking about for the final time in this webinar, so we'll lead on to that in a second. And finally, China had a bit of a catch-up rally in April, which obviously generated extra alpha into our portfolios as we have an overweight there. Did sell off a little bit more off the back of that, but see reasons in the months ahead for that to pick back up again. So that's good to see. Looking at how that affected the P portfolios, I will see there that all portfolios outperformed their respective benchmarks by a considerable margin. Just as an example, the lowest risk portfolio outperformed its benchmark by 2.2% over the quarter, which is obviously fantastic. And the smallest amount of outperformance was actually P5, which outperformed by still 0.6% over the quarter. So very, very positive in regards to that. The R portfolios, again, all outperformed their respective benchmarks, but due to the way that the R portfolios work, they were much tighter to their benchmarks, but still around about 0.6% outperformance there versus their benchmarks over the quarter. So really positive, and circa in the region of 1 to 3% growth over the quarter. So that's rather positive indeed. And this performance obviously carries on through as well when looking at the year-to-date numbers. On the P portfolios, we now see performance between 3.78 and 9.45% for the year. And looking at the Rs, we have between 2.29% and 10.49% of the year. So considering we're halfway through the year, very positive start to the year. It's about making sure that we keep ahead of where the benchmarks are going to be for the rest of this year. Typically, this quarter tends to be, the first half of it at least, relatively quiet, just as people are going on holidays, etc. There tends to be a little bit less in the way of big news that comes out. But wouldn't be surprised if, say, in September and going into October, there'll be a flow of information, a little bit more volatility into the market there, just as more news flow comes back in. Looking at the top performers over the quarter, there is one fund missing from this, but that's because I'm going to talk about it in just a second. We see, as I mentioned, China there, proven to be one of the best performers in the portfolio there, returning just over 7%. And what's quite nice looking on the P portfolios is we see 3, 4 are both active names, and number 2 is an overweight within the portfolio. So all of those best performing funds there are very much areas that we've made an active decision to be exposed to. Looking on the worst performing funds, Japan's actually had, I think probably for the first time in a long time, actually had a little.
As much as it's a negative there, it's just had such a good.
Exactly, yeah. It's had such a run. It's just consolidating off the back of it, pulled back 4%. But what I would point out there again on the P portfolios is that if you see there on worst performing line 3 is our active position on Japan is still outperformed the passive by close to 2%. So good from that perspective that we, even within the overall sector that's been down, we've limited the downwards pressure on the portfolio. So that's quite positive there. Looking at what the trades over the quarter, this is actually the most busy quarter we've had by a long way. Part of that is due to a switch from legal and general passive funds. They raised up the annual management charge that they're going to charge us on those funds. So as a result, we did move away to cheaper alternatives where available. Obviously, we want to make sure that the overall cost of the portfolios is the most efficient that it can be. But they're looking at the opening part of the month. I've lost my tool. We see here a flurry of trades for Hypnosis Songs Fund. Again, we'll talk about that in just a second, but as a complete removal of that over a phased period through April, as well as a few additions for things like adding in inflation-linked gilts, just as the gilts market was very much kind of topping out in terms of yield. So taking that opportunity, as well as looking into the later part of the quarter, we saw utilization of the cash that had been realized from the Hypnosis sale into increasing UK mid-cap, as well as a small increase in our US position and a further increase in our sterling investment grade bonds. So a good spread of where we're putting stuff in the risk spectrum, but it isn't going all out on increasing the risk within portfolios. It's about keeping things well managed and where we see that there's future potential as well. Within the sterling bond space, I think is quite interesting at the moment, but I will leave that for if there's any specific questions from anyone. And yeah, as I just mentioned, on the quarter, 37 trades, our busiest quarter so far in the year. We're at 49 trades, so still a busy year. Of course, we're not just trading for the sake of trading. You know, that would typically prove to be inefficient in the portfolio, but where we see opportunities, we will find a way to utilize them and help generate further returns. So for the final time, let's talk about hypnosis. So possibly even better if I look at the 1 year chart first. So we went through a long period with Hypnosis Songs Fund of downward pressure on pricing, largely from corporate governance standpoint. It was becoming increasingly evident that there was conflicts of interest, there was poor accountancy practices creeping in, etc. But we took the opportunity end of December from memory to do a complete from scratch bottom evaluation of the assets in the trust, and came to a figure of, in our belief, it was still worth 92 pence, which at the end of last quarter here, we were looking at circa 56 from memory, which we found it really frustrating that it got to that price, because we felt that we couldn't increase our weighting into this further from a risk perspective in the portfolios, but we knew that there was definitely extra value to be had there within the fund. Fortunately, well, certainly fortunately, there was a series of a takeover offer from a consortium who saw the value of the assets within the fund. That offer actually came in at exactly 92 pence per share, so exactly where our valuation came in at. But what was very pleasant as well, further went on from that, was that there was a bidding war with Blackstone that pushed the share price up further, eventually to 102 pence per share. However, we blended an exit out at 87, which from around about 56 we're very happy with. As I said, year to date, that came out at our final exit point at 27.78%, which we're very happy to have, you know, stood behind our conviction that there was value behind that position, even if it was very tricky through at times, and that we came out with certainly not a negative overall outcome within the portfolios. Is there anything you want to comment further on that?
Yeah, I mean, I think hopefully it's the last time it's a slide in the presentation. But yeah, as much as we're almost happy to get out flat on a capital value, I think, you know, we still reinforce that we bought it as a yielding investment with a, you know, very long dividend history, and like Shell and BP and others at times that have had shock cuts that people never thought would come. I think that remained probably the most disappointing part, which again goes back to the corporate governance side. I think so. As much as we're up flat, yes, we would have loved that, you know, allocation A to be yielding, or, you know, to have been somewhere else. So it's kind of more closure on it. It's banked the additional returns for this year. But yeah, again, as Sam said, move not immediately onto something similar in nature. We've elected to, you know, kind of split that across, you know, bonds and equities, which again goes back to our original placing in the portfolios. You know, the fact that it wasn't designed to be a high risk position, but, you know, there's always risks in gilts, liquidity in high yield bond markets just as much as equity. So, you know, all asset classes at times of stress and you know, behaving differently to that have traditionally, but there will always be downward risk. That's why it's investment. But yeah, net, obviously it was a very positive couple of weeks, and happy that we held the majority of that position right to the end and got a decent exit point.
Yeah, indeed. So just a further fund and focus to look at, you know, what's under the hood, so to speak, of portfolios, was to take a look at the T. Rowe Price US Structured Research Equity funds, which is similar to a fund that I previously touched on. So within the US, it's actually quite difficult to find an active fund that that generates outperformance versus over the index. So admittedly, you could do the colors being slightly further apart from each other, but the dark green, the one on top, is our passive holding, and on the bottom there is what the average industry active fund return is over that same period. So that's over about 11.5 years. We can see that is, underperformed by around about a fifth compared to just holding the passive. So what makes this different is from way of how it works, they just take very small differences of position across the whole index. They don't make very big conviction plays. America is obviously the most surveyed market in the world, most analyst coverage in the world. It's very hard to find something that an awful lot of people don't already know. So they just try to do things off of a tiny little bit on each one. And as you can see here, it just over various market conditions, just has a very good track record of providing a little bit of excess return. This isn't going to be a fund that's going to outperform the market by 20% in any one quarter, just looking for a little tiny bit all the time, just nice and consistent. And as you can see there, over a long time period, going back to 1999, which, wow, feels a very long time ago now. We can see, net of fees, this outperforms on average about 1.25% a year, just a little bit, just adds a little bit more. And what's quite nice about this as well is that it's actually rather cost effective. It's for an active fund, is quite cheap at only 1/8%, which, as I said, there's only 0.06% more than passive. So it's a very, very cheap active play with a very long track record there. This is split between something with a similar process, which is the JP Morgan, a US fund that you'll see on your statements. In case of hedging risk there, if the chances are is that if one doesn't get it right, the other one will, but it will only be small amounts. And as we saw on the, sorry, going way back here, these two are outperforming their passive equivalents by between, just a little bit in the case of the JPM one, 0.1% over the quarter. The T. Rowe Price one is 1.25% ahead over the quarter, but you keep on times that through across the months, across the quarters, and obviously US equity makes up the largest part of the equity component of the portfolios. So just those little bits every month do make a big difference within the wider portfolio. I think it's just a new way of trying to generate outperformance in the US. And yeah, just since that was added, see there that it performed 6.61% compared to the passives 4.53, so a good margin there above. And the active equivalent would be some 4%, well, 3.5% down at 2.15%. So it's certainly a good addition to the portfolio, and one that I feel will be on a staple within the portfolios for quite a few months to come. Just wanted to quickly point out the other end of the risk spectrum within the portfolios on our active positions on bonds. So we hold two Man GLG funds within the active part of our bonds components. We see here again, they've been performing really well over the course of that. This is also applicable over the year as well. The sterling, the investment grade there, generating 3.17% compared to its peer group composite giving just 0.09%, so 3% there of outperformance just from the quarter. Just a really good fund manager, really clear process that I think I touched on last time. But similarly, the Manjo high yield there, we've known Mike now for a long time, 5 years. We don't just stay thin just because we know him well. We've compared around to his peers. Obviously we have meetings with lots of fund managers on a regular basis, and just we really buy into his process. It's rational, and as you can see, they're outperforming his peer group composite there by about 1.5% over the quarter, and that's kind of typical of Mike, because he does tend to outperform, certainly across years. I think there's only 1 year we've been with him that he's underperformed, but he was very frank with the reasons why for that, and it was quite obvious that he learned from what he'd done and what he needs to do moving forward. Making quite good progress through my slides this week. Normally I waffle a little bit more. So looking at this quarter that we now sit in. So looking at the inflation, there's a big number out today. It's US inflation day. So that'll be quite an important one, not just obviously for what happens within the US markets, but also what happens with the US dollar. We still have on our US equity positions 50% dollar hedge, and actually on our US Treasury, it is very difficult for us to hold a fund that doesn't have a dollar hedge. So those figures are very important to portfolios every month. US data, the economic data is softening. Unemployment is creeping up at a very slow pace, as well as demand factors are looking a little bit softer. I'm not saying it's something that's showing up amber at the moment, but it's certainly less green than it was, say, 12 months ago. And it's one thing I would say is it's not necessarily how the US looks in isolation, but it's how it looks in compared to other economies. I think US versus UK is perhaps quite an interesting comparison to do this year. The UK looks like it might be kind of going the other way, and the economic numbers starting to accelerate, which is obviously a fantastic point for my final point I'll come to. As I mentioned, government bonds, the yields seem to have found the ceiling, which is nice. I think we found now a very rational when to buy in if things creep up, and when things come down, when to move across the risk spectrum within the bond space, and how we can go from protecting returns to, okay, let's put the risk back on to try and generate some more. I think, much has been said an awful lot about, interest rates are coming down. I think the tail end of this quarter, so I'd say August and September, is probably when you will see the UK finally move on rates. It's now looking like the market's been a lot more rational with its decisions. It's still pricing in 2 rate cuts for the US, which still seems a little bit optimistic. I think one seems more rational, in particular due to the elections. As we know, every part of systems in the US are very politicized. The same applies for how the Federal Reserve is perceived. It's quite likely they won't want to cut rates when the US election is in full swing and really intense. Be seen to be given political favor, etc. So I think 1 rate is perhaps more likely than 2 there, but that will no doubt give a degree of impetus there. China valuations, as mentioned, we had a rally in April, came back off a little bit of that. It wasn't actually necessarily for data reasons. I think it was more people just chose the opportunity to take a little bit of profit out. We see that there is opportunity to to push further beyond those April highs. I think at that point might be when we start to reduce the overweight. Similar to the hypnosis story, we've had to have the conviction to stay with the position when some people have been very unhappy with it, quite understandably. But it's important not to capitulate when news is typically at its worst. You will very commonly find that news is overtraded, whether that be positive or negative. So we carried through that, and we're probably now on the recovery phase of holding that. But we will certainly, I'd be surprised if we're here end of this year and talking about China as certainly such a large influence on the portfolio. PMI data, so that's purchasing manager, so that's company survey data. Again, the UK's looking decent. US is softening a little bit, and Europe is perhaps not looking as positive as it was. Depends on what country within the Eurozone. Germany manufacturing data still looks quite poor. However, there are areas, say in Italy, non-manufacturing, that are starting to accelerate a little bit. Of course, this all comes with a little bit of an asterisk of what is going on in France at the moment. I think the thing that we're waiting to see there is some stability, so that we can, make an intelligent decision on what's going on there. I think the worst thing that we could do at the moment is make any rash decisions whilst it isn't clear what, obviously, although the election has concluded, what kind of like the political stance overall within France will be a little bit more. I touched on earnings earlier, and then a UK mid-stroke small cap. So what was one thing that has been very interesting is that there's been an awful lot over the last 5 or so years of outflows from UK markets. Valuations within the UK are incredibly depressed compared to their overseas counterparts, and it's created a valuation highlight, really, where to find some value within the portfolio. What's been interesting is you're now getting two elements perhaps of tailwinds that to help push up values. One is you're getting quite a lot of takeover activity from abroad, as I said, because they're seeing value within these companies now. And also you're seeing macroeconomic data perhaps picking up, which will help give the tailwind, particularly on these mid and small cap valuations. This will probably be holding, I'd imagine, would hold for a further 9 months. It's probably when that story will play out. And the important thing here, though, is as it is, as I said, more down the small cap part of the range, it can be a little bit more volatile. So we've moderated the percentage holding there to, help control the overall risk within the portfolio. Any other thoughts about what's going on forward?
No, I mean, I think most of it's, lots of good points there.
Yeah. And then just very quickly putting up this table, which I'm really sorry, but unfortunately there's no better way for me to present this. I think you might be able to zoom in perhaps on your screens or similar, but I tried to call out some bits. So you might be surprised with deposits earning as much as they do at the moment, but we actually have minimal, quite literally minimal rather, cash within the portfolio. The reason for that is as the bond yields topped out end of April, we pivoted that into short duration, where we've certainly benefited from that over the last 8 weeks. It might be get to a point where we might put some cash back on just to help take some profit out from that, but that's worked very well. So might be surprised a little bit that US equity it says here, sorry, I'm trying to do this is not the easiest thing on the planet. It says, particularly on the higher up portfolios, that we're 2% underweight. I'd like to point out that that's actually a bit of a quirk of our benchmark. So the benchmark, one of our constituents in that benchmark added 10% to so it's not so much of we've taken money out, it's just one particular benchmark constituent just decided to go all on black last month, which wouldn't have worked. So that is something that we will correct in due course, but only when we find the timing is right to correct it. US market is so large, it's not something that we like putting a huge move on this basis. Just thinking also alternative assets, obviously, as we've now taken hypnosis out, is now quite changed, very much an underweight. That isn't a case of we don't like them. It's more of a case of finding the right kind of alternative assets. So infrastructure, for example, might take a bit of a play there, particularly if there's a little bit of an economic downturn. However, when hypnosis came out of the portfolio, those bond yields were rising up a little bit still, and infrastructure gets really hit hard off of increasing bond yields. So
it's kind of been the forgotten child, hasn't it?
Yeah, you know, when we go back 2 years, everyone was clamoring for infrastructure, and
it will have its time.
Yeah, exactly. It will have its time, but we don't want to go for things just for the sake of being in fashion. It needs to have a logical investment proposition behind it. And yeah, so in record time this month. Of course, definitely welcome any and all questions that you may have, whether that be through here on a public platform or contacting myself, Mark, or your advisor. I think I see one coming through. Are we rotating back to North American equities? So yeah, as I mentioned, that's just more of a quirk of the portfolio. It'll be this month likely. We do have a quarterly portfolio rebalance anyway within as a procedural effect, and they'll get topped up then. Where it will come from might actually be that short duration position that I mentioned a little bit earlier. But one thing that's also quite important to know is US is expensive at the moment, and I don't mean compared to other markets or, you know, off the Magnificent Seven. Even over a 1 year kind of basis, it is a little bit expensive at the moment. So there might be parts within the US market we fancy more than others, but there will be certainly a rotation back into it in due course.
I think, yeah, just a few comments on the sort of end of year changes, and, you know, 6 months into the P and the R portfolios. You know, we think, yeah, the merging to the P has definitely sort of sharpened the tools there, reduced, you know, some operational frustrations, and you know, really just allows for a simpler, more condensed decision-making process. Whilst at the same time, yeah, running and bringing something new in, like the R portfolios. That, you know, was a case of, again, listening to sort of advisor and client demand, and I think, yeah, they've certainly shown value and shown their role, and yeah, each client's been different on whether they've been interested in using them or not, but yeah, he's been helped by hypnosis massively. So again, you know, as we said, they're two different approaches to investment, both benefit from the same research process, but yeah, no, overall very happy with how that's gone 6 months in.
I think one thing I would add just to that actually is the outperformance of P hasn't been just due to the hypnosis rally. very much been very happy with our active positions within the portfolio. Definitely, of course, as soon as the numbers look great, we had a look to see how would our performance look if hypnosis didn't exist. Excuse me. And it was, we're still very much ahead of benchmark on all portfolios year to date. So very happy with that.
And I think only other comment is, as much as Sam spoke on the bond markets, and absolutely the right move to move out of the money markets to the short duration. And I remember Sam putting the graph in front of me, and short duration's done 600%. Yes, Sam. Yes, Mark. It's the right. So the logic there in holding that, and again we go back to lots of all the forecasts of January 2022. And we haven't had that movement in bond markets yet in terms of capital. Sam also likes to always bring up even gilt still capital wise down 25 plus% from where they are. So we dodged lots of that, and looking forward to the rest of this year and into the next couple of years where it's been a good period to bank some high interest rate driven returns. But there's definitely space for some capital returns to come in the next couple of years, and we're constantly talking about that and on that. So, but it doesn't look like any further questions. So thanks as ever, and see lots of you in meetings and things, and have a good quarter.